Hello and welcome. I'd like to thank everyone for joining us on today's webcast, Commodities through 2013, Buying Opportunity or Buyer Beware, hosted by IHS, the leading provider of diverse global market analysis, economic insight, and commodity intelligence. My name is Rory King, and I will be your host and moderator for today's event. Today's webcast is part of a series of webcasts. It's the first installment in the series, IHS Supply Chain Thought Leadership, Best Practices in Strategic Sourcing and Procurement. Join us for our next event, When Will China Lose Its Low-Cost Edge, on December 6th to hear from Laura Hodges, who will be talking about why China may be approaching the end of its low-cost status and how this will impact your supply chain. In addition, join us again on January 9th for 2013 Steel Buyer's Guide, as we'll share IHS steel forecast for 2013. Please note you may join the conversation on Twitter today. Follow IHS using the handle @IHS_supply chain. Follow along using the hashtag IHS Webcast. Note that that's IHS Webcast singular. Join the conversation. Today's event is also designed to be interactive through the console and the screen, so please ask questions at any time during the presentation by typing in the text area and clicking Submit. Our presenter will answer your questions at the end of the webinar, and we'll go through the questions as we see them in the queue. Also, you've already submitted a lot of questions that we've shared with our presenter today, so please enter them into the system whenever they come to mind, and we'll address those at the end through Q&A. As you see on the screen, please, later in the program, we ask you to complete a short survey. This is very important to us, and we'd appreciate if you would take a moment to fill it out. Your feedback is very important to IHS, not only about today's topic, but critical topics in the supply chain where we would be very interested in your feedback. IHS is offering everyone who completes today's survey a chance to win a Kindle Fire HD. The survey can be found at the bottom of the webcast console, and you may need to disable your pop-up blocker if you're unable to view the survey. So please do take our survey when you get a moment. And now for today's presentation. Our presenter today is John Anton, Principal Economist at IHS. Mr. Anton is the manager of the IHS Steel Service and the Ferrous Metals Industry Analyst for IHS Cost and Industry Service. In addition to his work with IHS Global Insight clients, John regularly provides steel industry analysis to magazines and dailies including Bloomberg, Purchasing Magazine, The Steel Business Briefing, American Metal Market, and Investors Business Daily, among others. We may also be hearing from John's colleague, John Mothersole, our non-ferrous metals analyst for the IHS Pricing and Purchasing Service. Mothersole is the principal in the Industry Practices Group, where he's the non-ferrous metals analyst. He also helps supervise the Pricing and Purchasing Services price and wage forecast, the construction cost and operation and maintenance cost forecast, that are prepared by the Power Planner Service. He has a graduate degree in economics from the University of Maryland, and he may be joining us during today's Q&A session for relevant questions. And with that, I'm going to hand it over to our expert and today's feature presenter, John Anton, to begin today's insight into Commodities through 2013, Buyer Opportunity or Buyer Beware. Take it away, John.
Thank you, Rory. What I'd like to do is, along with the title, try to tell people what to look at for the next 3 months and 6 months. Is this a good time to go, or is this a time that prices are high and the longer you wait, things will be better? To that order, I'm going to phrase it as bluntly as possible. Right now, is this a buying opportunity, or are you better off sitting on your wallet? What are you going to look at if you have to buy commodities? And I'm going to look at steel, chemicals, copper, and aluminum. And for those, the advice certainly varies. To that, this is not a time where there's an overarching trend. In 2009, the recession was hitting, everything was going down. In 2010, we were in recovery, almost everything was coming up. There is no overarching trend right now. Therefore, what you see is different advice for different materials. So first, steel. Buying opportunity or sit on your wallet. Steel, buy it right now, because prices are at the bottom. They've actually started to rise. If you don't buy now, live hand to mouth and wait until July or August of 2013 when prices start to decline again. So you'll have at least 4 months and probably 6 months of price increases from this point forward. Organic chemicals. I'm going to look at ethylene and propylene. And the story is different for the two. Ethylene is flat, so there's really no reason to buy in a hurry, but there's no advantage to delaying either. Propylene, buy now. Propylene will go up. If you want to buy it, this is a good time. Copper, live hand to mouth. That really buy what you need, but the longer you wait, the better it will be. We think copper prices are going to go down, and late in 2013 and across 2014, they could go down very significantly. Aluminum is a different story. Aluminum is buy on the dips, buy it as you need it. Aluminum can't go down much because it's at cost. If it goes up much, it won't be sustainable because there's a lot of supply. Therefore, if it goes up, wait a little bit, it'll come back down. If it's down, go ahead and buy it because it's not going to go much lower. So the rest of the presentation is going to be explaining why I gave those pieces of advice I did. Looking at GDP for the United States, what we're looking at is quarter-to-quarter GDP growth, annualized, and what you're looking at is now that this vertical line should be moved over, we're actually around 2013, we're near 2% growth. And we're going to be near 2% growth for most of 2013, improving into 2014, but 3.5% was what we had for almost the entire second half of the 90s. So we're just now by 2014 getting up to what we had for a 5-year running in the past. And so we've been way below trend growth rates. We're just now getting back up to trend, and it is a growth pattern. The good news is things are growing. The good news is the economy is getting better. The bad news is it's not getting better very fast. And so the economy should not be putting a lot of demand-side pressure onto raw materials, onto commodities. That what you're looking at is a kind of a status quo year. 2013 will look a lot like 2011. Excuse me, like 2012, my apologies. So it's something of a status quo year, a little better, but not much. Some things that are helping and some things that aren't helping at all. And why we're looking at better outlook for manufacturing and for consumers to some extent than we are for real estate. Every time in this graph, 4 quarters to it, anytime it's above 0, it's harder to get a loan than it was the day before. So in the top left graph, it's coming down from 2009 to 2010, but still it's until all the way through that period, even though it's not a lot harder to get a loan, it is still harder to get a loan all the way through the end of 2010 for commercial credit than it was the day before. Only in 2010 and forward has it started getting easier to get a loan. But you can see it's barely gotten easier, and for a long time it got a lot harder. So on balance, while it's better for commercial credit, it's not a lot better. Same thing for commercial mortgage credit. Very hard to get a loan for a protracted period. Only for a few years has it gotten just a little bit easier to get a loan. So, but commercial certainly doing better. Lower left, consumer loans. Consumer loans have definitely got eased up. They're still harder than they used to be. You could get a loan if you basically just showed up at the door. Now you actually have to show you can pay it back. That's actually not a bad thing. But auto loans and credit cards are both easier, particularly auto loans. That's why we have autos as one of the strongest sectors in the economy, and I'll show that in a little bit. That means very good things for most of the commodities we're talking about, steel, aluminum, and plastic in particular. Our demand is doing very well from automotive, and that slide has a lot to do with it. The downside is the one on the lower right, home mortgage credit. Mortgage rates are some of the lowest in United States history. it doesn't matter. If the loan rate is 0, but no one will give you a loan, it doesn't matter what the rate is. It matters whether someone will give you a loan. And as you can see, it got much harder to get a loan from 2007 all the way through mid-2010, and it hasn't gotten any easier. It's bouncing along the 0 line. That means it got a lot harder, and there's been no improvement in your ability to get a loan. So it might take a credit score of 600. Now it takes a credit score of nearly 800. It's very hard to get a loan. That is really depressing residential construction, and it will so over the next several years. That is bad for all the commodities we're talking about today. Going on to looking at housing starts then on slide 10, what it's showing is that things are improving, that even though it's harder to get a loan, people need to get a loan. Housing has been very depressed. People are living in their parents' basement. People are living with roommates who'd like to buy their own house. There's a lot of upward momentum, a lot of deferred demand for housing. It is starting to come back. And you'll see some spectacular percentage growth rates over the next year. We've already seen almost a 50% increase in housing from the bottom. But the most important thing is housing used to be around 2 million units. It fell down to 550,000. If it goes from 550,000 to 800,000, that's a very large increase. It's still only about half of what it should be. And that's what we're looking at for housing for 2013 and 2014. Not a lot of pressure on steel, not a lot of pressure on copper wiring because things are just growing tepidly. Actually, they're growing rapidly, but they're still far below where they used to be. You're climbing out of the Grand Canyon, if you might think. Mobile homes are rising very rapidly, but if you take that entire right side graph for mobile homes, it fits under the very lowest line on the left hand. The maximum there is 250,000 a year. The smallest line on the left is 300,000. So mobile homes, while recovering quickly, are a very small sector and don't really move the market much. Looking at slide 11, this is the most important thing for steel. You see a lot of copper, some aluminum in residential. Almost no steel goes into residential, certainly not in single family. But non-residential construction is the biggest consuming sector of steel. And as you can see, we had a good bit of recovery in 2011, but the recovery has stalled. And we expect, at least for the first half of 2013, if not for the whole year, that non-residential construction will be flat. So the level you see right now, adjusting for seasonality, it always falls in winter and rises in summer. But beyond the seasonality, what you see right now is what you'll see for at least the next 6 months, probably the next 9 to 12 months. And it is at about $350 billion a year. It used to be $470. That's a lot of construction not going in place, and therefore a lot of pressure not upon reinforcing bar, structurals, anything being used for the construction industry. There's a lot of pressure that has been relieved. And in fact, capacity is in good shape. And so that affects all the commodities we'll be talking about today, but most importantly, it affects steel. The very good news, the strongest market in North America, automotive. As you can see, it slowly trended down from 2000 to 2007 from about 16 million units down to 15 million. And then the bottom dropped out in the recession. The worst year there, 2009, is only 8.6 million units, so almost barely better than half of the 2007 level by 2009. And the recovery hasn't been particularly rapid, and that means a lot of cars weren't built. People kept driving cars they didn't want to because they couldn't afford a new one. Cars are wearing out. The fleet age of private individuals is one of the oldest ever in the United States. About 11 years, I believe, is what I heard. So you're looking at cars that are wearing out. It has come roaring back. This year will be almost at 15 million, which was basically the 2007 level. Next year will go over 15 million, and in the out years it grows very well, taking it forward a bit more than most of the graphs, but I just wanted to show because so many cars weren't built in the last few years, the long-term outlook for automotive is very good. And this benefits copper to some extent. It benefits aluminum, plastic, and steel to a very large extent. Plastic for dashboards, aluminum for weight saving, and steel for the main part of the car. So this is a very beneficial part to all the commodities we're talking about today. It will exert some upward pressure, but that pressure is something that the industry should be able to meet. Now, China synopsis. Some of the pre-questions already were asking about China. It's very important. China is so important to commodities that it really dominates everything. Half of the steel in the world is made in China, almost. It's about 46%. During the recession, it was over 50%. Cement is huge in China. Just an entire range of products. China is near 50%. Cement is over 50%. And so what you're looking at is what happens to China impacts the entire world. And where we're going with China is those who believe that China is going to have, that the bottom has dropped out. We think emphatically it has not dropped out. But what you're looking at, you can see the growth rates here. 10.5% GDP in 2010, slowing to 9.2. This year it's going to be about 7.4, 7.5, and next year will be a little bit stronger. Now, the problem is why steel prices are low and why some other commodities are quite low right now, and I'm saying problem from a steel maker. If you're a buyer, this is good news. The steel makers in China, 7.4% growth is spectacularly good, but they were expecting 10.5%. And so if you're expecting 10.5 and you get 7.5, you're not overjoyed at a great 7.5. You're stuck with excess inventory because you're expecting 10.5. And that is really an underlying theme to a lot of the commodities right now and a lot of the global economy, but mostly for commodities, is China did not stop growing, but China did not grow as fast as commodity makers expected, and therefore there's been a lot of overproduction. There is a risk of a hard landing. We think that risk is declining. Some of the things that have happened in China have been positive. They have overinvested not only in commodities, they overinvested in real estate. As we know, unfortunately, from the United States, overinvestment of real estate can build up an inventory that can be very bad for an economy. They're working it down. They have a strong fiscal position so they can do stimulus. And so we think that the stimulus that's going forward now, some construction, a lot of rail, a lot of electricity transmission, again, very good for commodities, particularly the metals. The last bullet here in red, though, is very important for the steel industry. And what it's saying is that a little bit of history. In the United States, from 95 to 2009, every odd-numbered year had falling prices. And from 96 to 2010, every even year had rising prices. So a very, very clear two-year price production cycle. Prices would get high, mills would overproduce, overproduction would build a surplus. Surplus would make prices crash in the odd-numbered year. When prices crashed, they'd cut production, they'd cut it too much. That would make prices start rising, production would rise, repeat the cycle. China has shortened that cycle from 2 years to 1 year. And now, every winter, low prices, every summer, high prices. And it's not exactly winter to summer, it's almost more like October, November is the bottom, May, June is the peak. But the easy way is winter low, summer high. It has repeated itself for 2010, 2011, 2012, and every sign, every indicator for production and everything else shows it's starting to repeat itself, and I expect it to, again, happen in 2013. And that is partly behind the forecast I gave earlier, buy now or wait till July or August, because we are at or past the bottom for steel prices globally, and the next moves are upwards. And it's just that 1 year cycle. It's not a fundamental. It's not that the world economy has gotten stronger or weaker. It's that overproduction means falling prices, underproduction means rising prices. and we had been in underproduction and rising prices are about to start. We do believe that Greece probably leaves the euro currency. We place the odds at over 50% that Greece is forced to leave, and as they do so, it weakens the entire euro and weakens the world economy. Now, the top part is by far more important than the bottom part. The top is we believe that Greece leaves the euro, that the rest of the European governments take fast, decisive action to make sure that the contagion doesn't spread to Spain or Italy or anywhere else, and we truly expect 80% or more odds that that is what happens. About a 20% chance, we believe, no more, that they don't take action and that things deteriorate, and if so, you get a recession on par with what happened in the United States in 2008, 2009. -4 to -6% GDP in the European Union. The U.S. and USA and Japan declined by 1 to 2% as the European sickness spreads here, and a hard landing in China. Again, we do not expect this. We put this at 20% odds or lower, but it is something to watch out for. If you see Greece leave the euro, as we expect, and you see European governments debate what to do rather than take action on what to do, then this becomes more likely. We do not expect it. I don't want to scare you to death. I just want to warn you to watch out for it. Okay, so the steel cycle, I already discussed it briefly, so I don't want to take too much time on it. But the new cycle is just like the old one. It happens every year. It used to be a 2-year cycle, now a 1-year. And in brief, output finally declining in China. It started falling in August. It should have started falling in May. So they built up a surplus. Falling output allows supply to tighten by late 2012. That's already happening. Tighter supply allows prices to rally late this year or early 2013. Well, they've already been rallying since the very end of October. They started rallying. The problem is, and unfortunately that is from a producer's point of view, not necessarily from a buyer's point of view. Unfortunately, China and the USA will react to, when prices start rising, they'll probably boost prices by more than they can actually get. So they'll put in price increases that will cause buyers to turn away, and they'll restart. Prices can only rise because they're taking capacity offline. Once prices start rising, history has shown that they'll bring all that capacity back online almost immediately over the first half. When they bring that capacity back online, it's too much. It creates a surplus. Second to bottom bullet, increase in output causes prices to crash over the summer, followed by production cuts once again late next year. This cycle is going on. It will go on again. A little bit more about steel, and I'll move on. Iron ore is also down. This means steel makers can sell steel for a lower price and not lose money. Ore miners are profitable when the price was $80 to $90 a metric ton. In most of 2011, prices were between $160 and $180. From 2008, taking out the recession, until mid-2012, prices were above $150. That means they are making profits of 70 to 100% profit. Extraction cost means price should be around, if they sold it for cost plus a little bit of profit, that'd be $80 to $100. They were charging $150 and more. We knew the price could come down, but we didn't think it would happen because it's an oligopoly. Basically, 3 companies control global iron ore. We knew the price could come down. We didn't think it would. They overproduced because they bought into China increasing at 10.5% when China rose at 7.5%. They overproduced. They caused prices to crash. They fell down to 90, but they've rallied back to 120, and we think they stay around 120. Significantly less than you saw the last couple of years. Still profitable, but a price of $120 a ton for iron ore means you can make steel for cheaper and still be profitable. So we think steel prices are, in 2013, will not rally much. So now let's look at a couple of prices. First, for steel. One thing to notice is that the green line for the USA and the blue-black line for Europe, in 2010 they were very similar. If you take this graph back a decade, Europe and the USA were in tandem, and China was always under. And anytime USA and Europe got a price increase and China didn't follow, USA and Europe fell back down to China, as if China was setting the minimum cost. Anytime the others got a higher price, they came back down. Since 2011-12, Europe has come down and is following China, and prices in the USA have been far higher than in other parts of the world. And that's one reason we see prices coming down. And looking at the forecast part of it, looking at the vertical line, that's where we are now. And actually, we're probably a little bit to the right of that. Another month has passed. So prices are about to go up. So if you want to get the lowest price for steel, and this is for hot rolled carbon sheet as a benchmark, this will happen to almost every steel product. If you want to get the lowest price, buy now. If you want to pay the highest price, buy in the second quarter. The worst time to enter into a long-term contract is the second quarter. The best time to enter into a long-term contract is right now. The peak in 2013 will not be as high as the peak in 2012. The trough will be a little bit deeper. So the low price next year, 12 months from now, should be lower than current pricing. That's because of the Greek exit. And so we do see a lower average price for 2013 than we do for 2012. The best time to buy for 2013 is right now or 9 to 12 months from now. Looking at petrochemicals, the practical advice there, again, cyclicality, the fundamental for propylene is coming down. Let's look at the red line first for ethylene, first couple of bullet points. Ethylene is based off of natural gas. It makes the ethylene family fairly cheap. And as you can see, the prices have been trending down since 2011. The prices for ethylene should trend sideways to downward. So it doesn't fall much. It falls from about 45 cents a pound down to around 42. Not enough to really hold up your production to wait for that little bit of a decline, but certainly there's no reason to go out and stock up right now. Prices would plummet, except for the U.S. is starting to export a lot of this. The other side of it is propylene. Different feedstock made from petroleum, where you haven't seen it, or a major contributor to a lot of it. You haven't seen the major price declines for petroleum, and so it is a higher price. And most importantly, just based on pure cyclicality, inventory goes up, inventory goes down. Right now we're at flush inventory, but inventories are being pulled down. Prices should rise over the next 3 to 6 months. On a purely cyclical basis, we advise buying propylene now. We think the bounce is already starting to happen, not much, but it will gain pace over the next couple of months. Now, there will be propylene projects on new capacity, so this price will not get out of hand long term. And the short-term forecast, again, 2013 will be as low or lower than 2012. But the best time to buy for 2013 is right now at the end of 2012. Aluminum. And John Mothersoul has joined me for question and answer session. I'm going to go ahead and go through the slides, but know that if you have questions on this, for aluminum and copper, John Mothersoul, our expert, will be taking them. But aluminum, you already see prices have already bounced. Prices are hovering. These are prices in metric tons. We think $2,000 is at or below the cost of production. And therefore, if it goes under $2,000, they're losing money. And recently, you're under $2,000. The price bounced up to around $2,100, $2,200. It's on the way. It will probably dip again. And so for this one, basically you should be seeing prices between $2,000 and $2,200 for all of 2013. The best thing to say is just buy on the dips. If it goes under $2,000, it's going to rebound. If it starts making a run at $2,200, it's probably soon going to come down. So buy on the dips, avoid the peaks. I'd love to say something more fundamental, that there's some great overarching trend, but really it's the fact that the biggest trend is it just can't go lower because we're at production cost, but there's so much supply that anytime it goes higher, it's going to undercut itself. Copper is a same story in the very short term, but a much different story in the long term. Copper, the cost of production is only about $4,000 a ton. And currently we're seeing prices, and we've seen them for some time, bouncing around $8,000. So very extreme profit. Extreme profit means more people are going to jump into the market. We have new copper mines, we have new smelters, we have new capacity. This is starting to put a long-term downward influence on copper. It had been hovering around 9,500. It started hovering around 8,000. In the long term, it starts making a move down towards 6,000. But we're talking mostly short term. What do you do for the next 3 to 6 months? The next 3 to 6 months is kind of like aluminum. Buy on the dips. We see sideways for the first half of 2013. We think when the Greek crisis starts bubbling over, that will be a cue for prices to start going down. But for the first half of the year, prices should be mostly sideways, maybe a little bit of downward bias, but mostly sideways for the first half of the year. So again, buy on the dips, try to avoid the peaks, and to the extent possible, the difference here is don't stock up too much on aluminum. This is one to not get locked into too much because the long-term trend is down. Now my final, not the final slide, but the last one on this, so what are the risks? I actually had this entitled, What Do You Do If You're Risk Averse? And I was told that was a little bit insulting. So forgive me, but this really is a slide, what do you do if you're risk averse? In other words, what are the things that could make your life, if you're a buyer, suddenly go miserable? And for steel, buy now. I don't think it's going to happen, but it could. Australian flooding. Australia had flooding in 2008. Cyclones in Western Australia shut down the iron ore mines. Flooding in the east shut down coal mines. Steel prices doubled in a matter of about 4 months. In 2010, we had flooding in eastern Australia that shut down the coal mines. We didn't have the cyclones that shut down the iron ore, and we had the second highest steel prices ever. And prices went up about 50% in a matter of months. I can't tell you whether Australia is going to have floods or not. I'm not a weatherman. But I can tell you when they do, it happens between December and April. And the last 2 times it happened, it hurt steel buyers badly. So if you're a steel buyer, at minimum, watch the Australian weather. I know it sounds silly, but anything that can break your prices go up by 50 to 100% is worth watching out for. Watch out for Australian weather, and if you really want to be cautious, lock in. And again, since steel prices are at a low, this is kind of doubles that advice. This is a good time to lock in. What if you're risk averse for non-ferrous? Well, there it's neutral. We could see speculators jumping in the market and driving prices up. We could see speculators seeing what we see for copper, selling it short and driving the price down. There's no overriding. We don't see anything like Australian flooding for non-ferrous. We don't see, now something could always happen. You could blow up every copper mine in the world, but that's not realistic. Realistically, we don't see any risk to the upside or downside that we can really say that should move the forecast greatly, other than Greece leaving the euro in the first quarter of next year rather than the fourth quarter. But so non-ferrous is neutral. The other thing to really watch out for is anything that comes out of South Africa. Stainless steel, platinum, palladium, and gold. They depend on South Africa highly. Over 50% of the chromium in the world comes from South Africa, very high amounts of palladium and platinum and gold. So those depend on South Africa, and South Africa is not dependable. We've had wildcard strikes at mines that have cut back on platinum and palladium quite a bit, and they have threatened, although they didn't go through with it, for strikes at ferrochrome mines. You cannot make stainless steel without ferrochrome. Chromium is what makes stainless steel. It's what prevents the rusting. And so we've had mine strikes. We also have a very bad electricity grid. You're moving towards summer in South Africa. There were brownouts recently in India. We've come very close to brownouts in South Africa. If you had transformers blow, you could have a power outage. And they have shown that when power gets tight, they're going to send it to cities, not to mines. So if you are we do not expect these things to happen, but if you're risk averse, in all those metals, risk is on the high side. Plastics, we're going to put that one a little bit less risky than steel and the South Africa, but the risk there is on the upside as well. And the risk would really be if Israel and Iran get into a shooting match, then oil will spike, and when oil spikes, it will take petrochemicals, particularly the propylene family, up with it. So those are petrochemicals. Petrochemicals depend on oil, and oil depends on Israel and Iran not getting into a shooting match. And so that's one we put as a little bit lower odds, but it's something that we do watch out for. So with that, what I'd like to do is talk a little bit about what the company is, how we were giving that. What I work with is a group. I do steel. I work with a group that forecast everything. If you're in construction, if you're in manufacturing, and more if you're in services, we forecast everything it costs for you to do business. We can't help you make any more money. We can help you spend less. IHS can help you make more money. IHS can tell you about construction, automotive, shipping. We take that and we say, what does that mean for materials prices? What does that mean for labor prices? What does that mean for machinery? So we try to help you make decisions. And we start with the reason we covered commodities today is what happens to steel affects pretty much every piece of machinery. What happens to plastic, to petrochemicals, impacts dashboards, it impacts packaging, it impacts food services. Same for aluminum and copper. So we started with commodities because what happens there affects everything you buy, and it affects our forecast. The steel forecast that I do translates into someone else's machinery forecast, and that translates into the automotive forecast. So we do a top-down model, and we get to that. And that is really what we're looking at here is a model that takes you, and I tried to give you commodities so that we could give you basically your purchasing in total. And with that, I'd like to start with question and answers. For the first question, I'm going to take, and I'm going to give the second one to John Mothersole. And the first question I'm going to take is what part of Australia is affected by weather? There's South Coast, West Coast. The eastern part of Australia is vital for metallurgical coal. Australia is now the metallurgical coal center of the world, essentially. And while the U.S. has plenty of this, it drives up prices in the U.S., and you cannot make steel literally in Japan, Korea, and you can barely make steel in China without metallurgical coal coming out of Australia. So when you have monsoonal flooding in eastern Australia, you cut off the coal supply. The iron ore mines are in northwestern Australia, and therefore they are more impacted by cyclones normally than they are by monsoonal flooding. And what happened in 2008 was you just had a freight train. I think 5 cyclones either hit land or went just to the north of Australia and therefore cut off all ore ships. And so you had just a freight train of cyclones come through that if they didn't flood out the mines, they certainly meant no ship could go. And in 2010, you had inland seas of flooding that were as big as Germany and France put together. And they poured water down the mouth of coal mines. It took several months to pump out. So that is really what you're looking at there is eastern Australia for coal, western Australia for iron ore. I'd like to have a question to John Mothersole now on the question is simply, how will China's economy affect copper pricing in 2013? I'm going to put it on speaker, so the sound will change a little bit, but John Mothersole will be looking at copper.
Sort of an interesting question. How does China affect copper markets next year? One of the things that's been very, very interesting has been the continuing increase in imports going into China as we've moved across 2012. At the same time that Chinese growth has quite obviously slowed, not just top-line GDP growth, but industrial production growth. And this difference or differential between continuing increases in imports, both ore, scrap, and refined product, stands at odds with the obvious deceleration in Chinese growth. And so the question is, where is all this material going? And the strong suspicion is that what we are seeing, or what we are not seeing, is an inventory build in China that is likely to undercut or hold back consumption growth next year, even as Chinese growth revives. We don't necessarily see a strong revival in Chinese growth, more of a stabilization and a slow uptick in growth from 7 to 8% to towards 8%. The question then becomes, what about the supply side of the market? If Chinese growth helps to restrain global consumption growth, the next question is, what about supply? And here's an interesting story. We do see a supply side build out that we think helps to push the market into surplus. So you have a revival in consumption growth, a rebound in consumption growth, but not necessarily as strong as one might suspect because of what we believe is this inventory build in China, coupled with the supply side build out. Fundamentally, a shift to surplus in the market, we think that exposes copper prices to a decline, and that's in fact why we have prices declining next year.
I'd like to pause for a moment, and Rory King would like to say a few words, and then we'll go back to Q&A. Rory?
Yeah, thank you, John. Very insightful presentation, and we've had a few questions, so we wanted to let folks know that we now have moved into the question and answer session of the presentation. So please do ask a question. The way that you do that is by entering a question into the text area at the bottom of your screen and click Submit. I'll point out we've had a bit of feedback on questions for John Mothersole around non-ferrous metals. So John, if you get the opportunity, maybe you could scoot a little bit closer to the audio-video connection there so that we can hear you a little bit more clearly,
sure.
If that's at all possible. So we'll give John and John a minute to glance at the questions that have come in. And some good news for the audience. There's a very good chance that if you direct a question for John, that you'll probably get a pretty responsive answer. So in all seriousness, though, while John and John are looking at the questions streaming in, we wanted to ask everybody, as you see on the screen, to please take a minute to fill out the survey. Was today's presentation helpful? What issues or regions or commodities are most critical to your 2013 plans? These are things that myself, John, and everyone here at IHS is very interested in your feedback on. So please do click the survey icon at the bottom of the screen while we're looking at the questions coming in and complete the survey. So with that, we'll go ahead and get back to the Q&A session. So John, I'll ask both of you again to please do take a look. We do have a lot of questions coming in, so please try to take a look at those. So John, we have a question. Will Europe be in full recession mode in Q1 2013? I think you addressed that through some of the presentation, but do you have any other comments about Europe that you might recap for us for next year?
What we're looking at for European recession is Europe is in mild recession now. They're just under zero. It is officially a recession. Germany has been, Northern Europe, not just Germany. Germany's been the star, but Northern Europe has really been carrying it. Most of the Southern European countries, Italy and Spain have been in recession for some time. Greece is in a depression, unfortunately. They're shrinking 5% a year or more and have been doing so for over 5 years. So they're down about 25%. Southern Europe's been doing much worse. Northern Europe's been doing better. Northern Europe has slowed to like 0.2, 0.4% growth. So Europe as a whole is in recession. We'll be in recession over the first quarter, probably pick up a little bit, not a strong growth, but probably be pulling out of recession, we expect, through the second half of the year, and then be tugged back down by the Greek exit. Now, Greece leaving the euro will not actually make their euro weaker. It should make it stronger. But in the short term, nothing that drastic can happen without people panicking a little bit. So we expect to be some negative as Greece leaves the euro, followed by a pretty strong pickup. And so Europe is in recession now, but we think that it's not a deep recession, and we think it will go up a little bit. So that's really what we're looking at there. And Rory, I guess, next question.
Great. So maybe moving along then, how will you see China's economy affecting copper pricing in 2013?
We just talked about that, and I think the slowdown in Chinese growth undercuts global consumption growth next year at the same time that we see a supply side build out shifting the market towards surplus, and we think the combination of the two sets up copper for a price decline.
Great. Again, thanks for the recap. I realize that we're getting a couple of redundant questions coming in here. So how do you gentlemen see Canada losing market share in the automotive industry through 2013? One slide it says, looked as though Canada would drop significantly while Mexico would be on the rise. Could either of you comment on that?
Really what's happening is you've had a lot of transplants moving into the deep south of the United States, and it's really that people are looking for lower cost, and particularly the Asian companies, as they move out of Asia and move to North America. You see the Hyundai, Toyota, Mercedes-Benz, BMW, they've all opened plants in the deep south. They're also opening plants in Mexico. And the Canadian plants are shrinking, but not much. It's more that growth is occurring in other parts of North America. And so the Canadian share is shrinking because no one is opening any new capacity in Canada. The new capacity is in Alabama, Georgia, South Carolina, Tennessee, and in Guadalajara and other parts of Mexico. And that's where the Mexican share is growing. Volkswagen, other companies have opened up in Mexico, and a lot of the Asian have opened up in the deep south but are also looking at Mexico. And that's really what you're seeing is the growth. Canada is faring a little worse, even as the rest of, particularly the deep south, fares a lot better. This is not to knock what's there around the Great Lakes. The Great Lakes aren't growing a lot, but their full recovery is an amazing story. There was already huge amounts of capacity around the Great Lakes. Almost all of it has come back. That doesn't imply growth, but full recovery is still a great story. And so that's what you're seeing around the Great Lakes is full recovery. Growth is happening in the southern part of North America. And next question, I guess.
Great. Thank you. We have a question on India. How does India's economy play into the global marketplace for 2013 and going into 2014?
That's a very good question. It's an interesting question because of the reforms or lack thereof that are occurring in India right now. I think what we've seen is a certain frustration with growth in India, and it has to do with some of the structural impediments to faster growth that continue to plague the Indian economy. And I think our view of what's happening in India and likely growth in India has been downgraded over the course of the year because of the pressures that we've seen build up, the inflation pressures, and with the concurrent slowdown in growth highlighted most specifically by the widespread power blackouts that occurred earlier this year. I think that's just symptomatic of some underlying structural or infrastructure problems that continue to handicap Indian growth. And so while we think there are a lot of positives with regard to India, there are these structural factors that we think will prevent India from certainly realizing certainly the kind of growth that we've seen, for instance, in China over the past 10 years. So, for an emerging market, we're still going to see growth that's certainly better than in the developed economies. But when we compare to some of the tiger economies, if you will, in Asia, we still are we're less optimistic that India, because of these structural impediments, actually is able to realize those more higher rates of growth.
Great. So we have some questions here on energy, crude oil and natural gas, and John, in your presentation, you commented on some energy risks. Do you have any other comments on possible outlooks on crude oil and natural gas or IHS insight in general in that area?
Yes. Let me start with natural gas. the news is, I guess, good and bad. The good news is the level is going to be quite low. Natural gas prices, particularly in North America, are they used to be $8 per million BTU. Now they're down around $4. In 2012, briefly, they fell down around $2. That was too low. That caused capacity to shut in. We've already back up well into the $3 range, low threes. By early next year, we should be, or right around 3 now. We see low threes for the first quarter, mid threes for the second quarter, going over 4 by the end of the year for natural gas per million BTU. So rising prices, but right around $4 is still a good price. So the bad news is the trend is upward. The good news is even when we reach the end of 2013, at the top of the price, it's still a very attractive price. Turning to petroleum is a little more difficult. Let me give you the non-risk case. The non-risk case is that prices should decline from now through 2015, maybe 2016. That just as natural gas, that shale fracking has completely changed the natural gas industry, tight oil out of North Dakota is changing the North American petroleum industry. And because of supply additions in North America, because of Iraq coming back online, because of a lot of things like that, the supply side is reacting very well. Demand has been very sedate in the developed world, growing in the developing world, but in the OECD countries, very sedate. Even as supply has increased, we see falling prices getting down to about $82 a barrel by 2015, 2016. Now, of course, that doesn't take into account risk of Israel, Iran, of Saudi Arabia, Iran. We can't forecast the risk. We can see several scenarios that could push oil to $150, even $200 a barrel. But if those risks don't come through, basically if we don't have war in the Middle East, then the trend for petroleum should be down from now to 2015-16. That falling price actually leads to underdevelopment and prices start rising for 2017 and beyond. But a very sedate and good forecast for those two. And I'm going to use that to segue into another one about someone asked, to contrast chemicals prices in China and Europe with chemical prices here in North America. And North America has a huge advantage because North America has the cheapest natural gas in the world. We have $4 natural gas. Most of the rest of the world has $8 to $12 natural gas. And so the U.S. and Saudi Arabia have the cheapest natural gas. Anything made from ethylene is made from natural gas. The U.S. has a huge advantage, and that's where the U.S. is adding capacity. We'll add more capacity, and will be a chemical exporter to the world of ethylene-based chemicals because they're based off of natural gas. Europe and China are based off of petroleum. And Europe and China have to import the petroleum to make chemicals. Petroleum, natural gas used to be a 10-to-1 ratio, $8 natural gas, $80 a barrel oil. Now it's $90 a barrel in oil, $4 natural gas in the United States. That relationship has broken down. If you're making chemicals from oil, you're paying a lot more than you are making it from natural gas. So China and Europe are at a huge disadvantage compared to North America and Saudi Arabia. The only way they can really survive is making propylene-based chemicals, which really require petroleum. To the extent that they make ethylene-based chemicals, they won't survive. And we honestly believe that ethylene-based chemicals in North America and Europe, in Europe and China, are at a cost disadvantage, which could be fatal. At best, it will mean barely any profit at all, and it could be fatal to that capacity. The propylene capacity, though, made from petroleum, should be set by the global petroleum price and won't be as drastic. With that, Rory, I'd like to turn it back. I think we have time for maybe one more question.
Great. Thanks, everyone. It looks like we'll go to, I don't know if you have any comments on a few other markets that have come up. I've seen some questions on silver, some questions on titanium. John, any comments on those?
Yeah, Rory, this is John Mother, so I'll take the question on titanium as it relates to the aerospace market. This is an interesting industry, aerospace. It looks like a very strong industry going across 2013 and 2014, and it reflects really record order books for both Boeing and Airbus. We've seen airlines really come back into the market over the past 3 to 4 years. Really, this interest really spurred by the new generation of aircraft that promise to be a lot more fuel efficient, and so we have product coming to market that it is really attractive to the buyers in the market, and hence the outlook looks very, very good on the commercial side, not so much on the military side because of the repositioning in forces or force systems because of changes in technology and the movement away from perhaps manned aircraft. On the supply side, the story is almost as interesting. For titanium, the demand outlook looks very good because of the increase because of the huge backlogs in commercial airlines or orders. But we've had a supply side build out, some strong investment over the past 3 to 4 years in anticipation of this very event or very fact that supply chains were gearing up for these new programs, the 787 and the A350 specifically, which require a great deal of titanium. So the industry has been anticipating this change in the market for some time, and interestingly enough, in the case of titanium, the supply side has really moved in front of the demand side of the market. I'll just say the teething problems in the ramp up in production in the 787 program have meant that this new capacity has come to market before the industry has really taken the product from the market, from the supply side. And so you've had a situation now for about a year and a half, where supply has really been in front of demand, and that's created some fairly weak pricing, or more specifically, you haven't seen the strong jumps in pricing that you normally associate with upswings in the aerospace cycle. So bottom line is conditions look very good for titanium going forward. In terms of pricing, though, we don't expect to see strong pricing moves until perhaps later next year and in 2014, sort of a delayed reaction, which is really a story in titanium because traditionally you've seen very strong price moves even early in the aerospace cycle, something that's not likely to happen this time around.
Great, thank you, John. And that was John Mothersole, again, principal in the Industry Practices Group, where he's our non-ferrous metals analyst. And our presenter today and the previous John was John Anson, principal economist at IHS Steel Service and the ferrous metals industry analyst for our cost and industry service. So thank you, John and John, gentlemen. It was a fantastic presentation, a lot of questions, a lot of interest in these topics, and we thank you for your time today. I'll note to everyone that at the bottom of the screen, you'll see the survey icon. Please do fill that out if you haven't already. That information is very insightful to us. Not only is it an opportunity to provide feedback on today's topics, it's also a way for us to get an understanding of some areas of supply chain, strategic sourcing, and purchasing intelligence that are of interest to you, and also an opportunity to win a Kindle Fire. So we have the information on those of you who have registered today, so if you fill out the survey, you'll have an opportunity to win that, and we most certainly appreciate your feedback. So with that, I'd like to thank you for attending today's webcast, Commodities through 2013, Buying Opportunity or Buyer Beware, brought to you by IHS. Again, a special thanks to our speaker, John Anson. And as a reminder that today's webcast is the first installment within the Supply Chain Thought Leadership series of events, Best Practices in Strategic Sourcing and Procurement. So join us on December 6th for When China Will Lose Its Low-Cost Edge. And again on January 9th for the 2013 Steel Buyer's Guide, where we'll hear again from John Anton. So with that, I thank you for joining us today, and please have a great day. Thank you.